Let's start off with Netflix. I don't know that you've been on since. Maybe you haven't. I missed it. You downgraded the stock for the first time, I think, in 10 years or more off that terrible guidance, of course. But now the stock is down, 38% this year. Tell me your thoughts about Netflix and whether or not there is a broader read, sort of to speak of, for a pull forward of demand overall.
Okay, yeah, a lot in there, Dave. Let's see. Netflix now on a PE basis, for the first time in quite a while, it gets close to, market reasonable multiples. So you have this thing's trading at now 25 times next year's earnings. That's 23 earnings for something that's a 20 to 30% earnings grower, we think. So the valuation is now starting to get into a place where it gets, highly attractive. That said, with this uncertainty over what's happened to sub growth, someday you were going to see the sub growth slow down. They were no longer going to be able to do 20 to 25 million new subs every year. And it looks to us like that was this period. So that's why we stepped to the sidelines. But I'm not a bear on it. I'm neither a bull. I'm going to wait and see if we get more clarity on what happens to the sub growth. If we can get back above 20 million subs, this is a great buying opportunity. I don't think that's what it is, but we're just uncertain.
Right. All right. Now, my second question, which I'll kind of ask again, is there a read-through from Netflix? You brought this up in a recent note, of course, maybe the idea that sub weakness reflects a greater or longer than expected pull forward of demand. Are you seeing that, Mark?
No, not yet. Not across other names, but we haven't got, we're just starting with earnings season. I'm sure we had a year pull forward of demand. Maybe it was 2 years for companies that are relatively well penetrated against their, secular growth opportunities. It's possible that we just pulled forward Netflix to saturation. I doubt that, but we certainly pulled forward some easier sub ads growth. I don't think you're going to hear that from Facebook. I doubt you're going to hear that from Google, and I strongly disagree that you would hear that from Amazon. So we'll stick with those kind of higher quality names here.
Mark, 2-year chart of Netflix versus Disney. They're finally coming back into a similar pattern in terms of returns. Even going into the print on Netflix, there had been some who said that trading the name on subs is just too difficult at this point. A lot of times the misses are statistically small, that it's going to be more about a margin and pricing story, which is a new way to think about the stock. Do you agree?
That would be a new way to think about it. I think as a tech investor, as a growth investor, you focus on unit growth more than pricing growth, ARPU growth. You get higher multiples for companies that can sustain premium unit growth like subscriber growth. Once subscriber growth goes X premium, when it gets more, you're adding 10 to 15 million subs a year, that's a lower multiple name, and that's exactly what's happened with Netflix. It's derated back to a PE basis as opposed to a EV to EBITDA or even a price to sales basis. That's the risk. So my guess is that the same thing that Netflix is seeing, probably other streaming companies are going to see. The best growth days for streaming may well be behind, and now you're trying to grow subs in much tougher markets. Call that India, different parts of Asia Pac, parts of the Middle East. It's just tougher markets to grow in.